I believe this week we have seen something that is maybe considered, you could call it a flip-flop, a change of opinion. Something is going on drastically different, and I don't think enough people are talking about it. We're gonna have this conversation with the one and only Anna Kelly. Hi, Anna.
Hi, good to be here with you.
So, what I saw this week, specifically Monday, Tuesday, and again this Wednesday morning, is we now have the Federal Reserve, right? These 19 humans who lord over the economy start to change their tune. For the last 13 or 14 months, they've been the big bad wolf saying, we're going to blow it hot. We're going to do this. We're going to do this higher for longer, higher for longer. We saw statistics as soon as last week that 60% of folks thought the Fed was going to hit us with another rate increase. But as of this Sunday, that was the first article, followed by Monday, Tuesday, the vice chair, Daly, all of these Fed presidents basically saying, think we're done. The market did our job for us. The 10-year Treasury is up 43 basis points since their last meeting. The lag effect is just starting to show up. Again, now the odds are 60% of a pause the rest of 2023. Quite the flip-flop in 5 days. What do you think?
Yeah, they've definitely become more dovish, even for those that were very hawkish before, basically meaning, okay, we think we're done with raising rates. Now, there are a few, to be fair, that are still saying we might have, more to go, but there's so much complexity, as we've said, in
Yeah.
this market, in our economy, that the risk has always been if something breaks, the Fed will be forced to pause or pivot. And that's what you and I have been saying as well. So, inflation is not yet conquered, but it's coming down. I mean, America is heading on a more deflationary path, but there are a few things that are still, inflationary. And so we're not technically in a recession yet, because wages and unemployment are not negative enough. But real wages are actually only like
Mhm.
0.02%. I think I read this morning, or 0.2% up. So they're just barely above flat, and unemployment is still starting to tick up. So we're not technically in a recession, but we have very recessionary conditions. We just also, have a strong enough labor market, at least at this point, that it hasn't, pushed us into that technical range, but we still have inflation. And so, I think that they still could raise rates. We did see PPI come out this morning higher than expected. I think 0.5%, so not a
Mhm.
huge number. Is that right?
Yeah,
0.5%?
point five month on month. Last month, point 0.7. Expectations, though, were point 0.3. So down from last month,
Absolutely.
but higher than expectation.
Absolutely. And PPI tends to lead CPI. And so that says, hey, inflation's not done yet, which they've all said. But on the other hand, the issue is you have more of a stagflation type environment where you've got low growth at the same time that you have high inflation. And so it doesn't mean that they're dovish that inflation is no longer a risk, but they're saying, how high do we have to put rates in order to get the consumer to break and have the rest of the economy start to slow enough, that inflation at least starts to come down on that, on that downward trajectory. And so I think what happened last week in the bond market is so much bigger than the stock market, and people don't really realize that. They just think, oh, bonds, it's something that individuals haven't invested in for a really long time, because we've had equity market rally
Mhm.
over, an expansion. So bonds were just kind of an afterthought. They didn't pay very much, so it wasn't worth holding. But a lot of institutions have them, banks have them, pension funds have them, and in fact have to hold treasury bonds for part of their reserves. And so what happened is, as rates are going up and up and up and the dollar is strengthening, these large players, foreign countries who are trying to defend their currency against a strong dollar, are basically selling and dumping treasuries in order to get more dollars to pay down their debt. But you've also got pension funds that are finally saying, oh my goodness, this higher for longer, it's going to stay. And as inflation, is still being battled, and the US takes on more debt, and the cost of servicing our debt because of rates is going to be $1 trillion, and more than what we spend on military, we're going to demand a higher rate of return to hold US treasuries. And so those that already own treasuries at a lower rate, people don't understand what happens when rates go up is the value of their bonds falls significantly. So it was like a mass sell and huge losses in the bond market. that historically, when I saw that, Michael, I thought this is what's going to break the Fed, because last time there was a bond outcry in early 2019, the Fed had to pivot from their rate hiking cycle in 2018. There was a backdoor rescue of the bond market. There has to be, we talked about last week, is the Fed put over? Well, they can rescue the bond market in a backdoor kind of way if they have to, but it's basically the market's crying uncle and saying, we can't continue on this higher for longer path, and we're going to have to demand much higher rates in order to do that. So I think that is what spooked the Fed, these Fed chair, not the chair, but all the people on the FOMC. The presidents of each of the regional banks to basically come out and say, okay, we might have enough pain. Then you add what happened in Israel and the attacks on Israel, and the fact that we're now being drawn into helping fund another war. And I think that's enough to say, okay, the environment is such that things are going to break if we keep things much higher, and we're going to have to kind of walk this fine line between inflation and the deflationary pressures that are there. That really can cause very slow growth in the economy as money and resources are pushed elsewhere to fund things like war that we can't afford.
Yeah, it's so again, if we kind of stay on the Fed topic, I think the Fed has flip-flopped or pivoted or whatever you want to call it. Now, be clear, I am not calling for a cut. What I'm trying to acknowledge is they've gone from the big bad wolf who was talking a big game to now a wolf that says, you know what? I'll just chill outside for a while. I'm done.
Right.
I don't know what I'll do next, but I'm going to stop trying to knock down your house. That's what I think the Fed is doing. I am not calling a Fed cut. In fact, I think if you gave them true serum, they would love to not cut for the next 15 months. I think their goal is 15 or 16 or 18 months of just flat sideways to kind of reset the marginal interest rate. And I don't know that they're going to be able to do that, because I think there's a lot of risk to something breaking. But I think that's what they're doing, right? The big bad wolf's not going to scare you anymore. The big bad wolf is pulling back. And now the big bad wolf's going to sit there and go, all right, let's see what happens.
Yeah, I agree with you. I do not think that we're going to see a pivot and a rate cut, at least not the rest of this year. I still tend to think that they understand that, these two forces, the two-headed monster of inflation and growth, kind of battling against each other. And although they don't want to, reignite inflation, and there's potentials for that, especially with oil prices, depending on what happens and how deep this war gets. I think that they're looking at the numbers and saying we might have done enough. They're going to pause for a while, and unless something breaks or this war gets much worse, they will not pivot, at least not for a while. So I agree with you, to that extent, and I think that it should give us some hope that at least wherever we are with interest rates, hopefully it's not going to go any higher. But the reality is the Fed isn't the only one that controls interest rates, right? So what we saw with the bond market and what we see with treasuries, that has as much impact on where rates go as the Fed does in their raising or lowering rates. And so, the amount of monetary tightening that they're still continuing to do, despite like video one, the mortgage industry coming back and saying, please don't tighten money supply and don't raise rates anymore. I think all those things are going to kind of work together to the Fed's advantage to naturally start to bring, rates back down, at least for a while. So I'm looking for a pause. I'm assuming rates are going to be the same, next year until maybe fourth quarter, unless, as we've talked about, something gets worse in the global economy that causes them to pivot.
Couldn't agree anymore with all of that. Anna, where can people find you?
You can find me here every week. You can find me on social media, Anna Kelly, REI Mom, and on my website, Anna Kelly Investing, for real estate coaching and consulting.
Thank you so much.